Navigating the Indian Crypto Market, an investor's guide with reference to Income Tax Act 2025. It is a comprehensive analysis with Income Tax Act 20. Executive summary. India's crypto market is now a fully legalized trading environment. But virtual digital assets are not recognized as legal tender. The tax framework is strict and punitive, designed to bring transparency and revenue. Key tax provisions: a flat 30% tax on all VDA gains, a 1% tax deducted at source, TDS, and an 18% GST on service fees. The no-loss set-off rule makes high-frequency trading financially challenging. Compliance is mandatory, with severe penalties for undisclosed assets. Legal and regulatory status. Legal status. Cryptocurrencies are not legal tender but are legal to trade and hold in India. The Supreme Court overturned the RBI's ban in 2020, establishing this legal precedent. Definition: the Income Tax Act 2025 broadens the definition of virtual digital assets, VDAs, to include all crypto assets based on distributed ledger technology, ensuring a wide range of assets, like NFTs, are taxed. Regulatory bodies. Oversight is a collaborative effort between the Ministry of Finance, the Reserve Bank of India, RBI, the Financial Intelligence Unit, FIUIND, and the Securities and Exchange Board of India, SEBI. Enforcement. Budget 2025 has focused on building the legal and technical infrastructure to enforce tax rules more effectively, with mandatory reporting requirements under Section 285 BAA of Income Tax Act 2025. The flat 30% tax on gains tax rate. A flat 30% tax is levied on any income from the transfer of a virtual digital asset. Taxable events. This tax is triggered when you sell crypto for INR, trade one crypto for another, or spend crypto on goods and services. No deductions. The only allowable deduction is the cost of acquisition. You cannot deduct transaction fees, brokerage fees, or other related costs. No loss set off. Losses from one VDA cannot be set off against gains from another VDA or any other income source. Losses cannot be carried forward to future financial years. The 1% TDS regime. Mechanism: a 1% of tax deducted at source, TDS, is applied to all virtual digital assets transfers that exceed a certain limit in a financial year. Thresholds: the limit is 50,000 rupees for business owners and traders, and 10,000 rupees for others. Responsibility: Indian exchanges. The exchange is responsible for deducting the TDS from the seller's proceeds. P2P, international trades. The buyer is responsible for deducting and depositing the TDS with the tax authorities. Crypto-to-crypto trades. The 1% of TDS applies to both the buyer and the seller. The exchange typically handles this by deducting the tax in the quote asset. Purpose: the TDS is a key enforcement tool, creating a digital transaction trail for the Income Tax Department. Other tax provisions of Budget 2025. 18% GST on service fees. A new 18% goods and services tax, GST, has been applied to crypto trading and service fees as of July 7, 2025. This tax is levied on top of the 30% tax on gains and the 1% TDS, increasing the total tax burden for active traders. 60% tax on undisclosed assets. Budget 2025 has classified unreported VDAs as undisclosed income under Section 158B of Income Tax Act 2025. Penalties: if unreported crypto holdings are discovered during a tax audit, they can be taxed at a steep 60% rate, with no deductions or exemptions. This provision applies retrospectively from February 1, 2025. Strategic investment for tax efficiency. Hodling versus trading. Hodling, holding, it is not a taxable event. Tax is only triggered on a transfer, sell, trade, spend. This strategy is far more tax efficient than high-frequency trading due to the no-loss set-off rule. Tax-efficient income streams. Staking, mining, airdrops. Income from these activities may be taxed as income from other sources at your individual income tax slab rate upon receipt, which can be lower than 30%. A later sale of these assets will still trigger the 30% tax on any subsequent gains. Family gifting. Gifting crypto to a close relative, spouse, children, parents, siblings, is not a taxable event. The tax liability is transferred to the recipient, who pays the 30% tax when they later sell the crypto. Compliance, record keeping and ITR filing. Mandatory reporting. You must file an income tax return, ITR, if you have any VDA income. ITR forms. ITR 1 is not permissible for reporting VDA income. Investors must use ITR 2 or ITR 3, which includes a specific Schedule VDA for crypto reporting. Required records. You must maintain meticulous records of every transaction, including the date, INR value, at the time of transfer, asset amounts, and the 1% TDS deducted. Leveraging technology. Due to the complexity of record keeping, it is highly recommended to use crypto tax software to automate transaction tracking and generate compliant reports. The future of regulation. CARF implementation. India plans to adopt the w.r.t Crypto Asset Reporting Framework, CARF, by April 2027. Global alignment. This framework will enable the automatic exchange of tax-relevant information with other jurisdictions. Implications. This move means that any attempt to avoid Indian tax by using offshore wallets or international exchanges will no longer be viable in the long term, as information about overseas holdings will be shared automatically. Information. If you are interested in any such other information related to finance and tax matters, kindly write us in the comment box or mail to financialeducation@gmail.com. Disclaimer: this information is intended for general guidance only and is based on the research material available. It is not and should not be considered financial, legal, or tax advice. Cryptocurrency investments are inherently high risk and speculative. You must consult with a qualified financial advisor and a tax professional to discuss your specific investment and tax situation before making any decisions. Thank you.